Dave, the way we think about Asia ex-Japan investments in our fund is more based on individual companies, characteristics that we look for: high returns on capital employed, free cash flows, high asset turns, and that naturally leads to some biases in the sectors that we do look at. Consumers, it's a endearing story for us because as income levels grow and brands get entrenched, consumers and income level help companies to do well. Internet, there is another sector which has high returns on capital employed, good cash flow characteristics that we look for, very competitive, but if you can get a fantastic positioning well up front, those stocks tend to do well. A great example is Tencent in China, which, as you know, for the last 15 years has been the market leader and continues to do remarkably well. Gaming, something like the Macau gaming casino, is going through a tough time at the moment, but if you look back at Las Vegas over the last 30 years, these are sustainable businesses. They go through ups and downs, but that's the kind of sector that we like as well. Logistics, telecoms, these are sectors that display the characteristics that we are most interested in: high returns on capital employed, free cash flows, high asset turns, EBIT margins. So the way we try and say is that we don't veer towards any particular sector starting up, but because we look for bottom-up characteristics, some of these sectors do give us the companies that we want to invest in. I think as we look around the region, you are right to say that ASEAN relative to the rest of Asia looks expensive, but I'd try and qualify that by saying that today looking at price to earnings or purely on price to book may not be the best way to analyze companies on valuations. The reason I say that is that we have so much of debt that has been taken on in several economies. Take China as a case in point. All of us know that the Chinese economy has thrived on debt, particularly from 2008-9. We have seen a significant mountain of debt built up in China. It's across the board. Of course, you have to exclude internet companies, some consumer companies, but broadly speaking, debt has been a significant problem for the Chinese economy. Any company that takes on significant amount of debt naturally has to trade at lower PE multiples because, as you know, once you take on debt, there is the problem that you might face bankruptcy if the economy goes into downturn. Fortunately, within ASEAN, even though debt levels have climbed, and I would particularly say Thailand and Malaysia come to mind, countries like the Philippines, the debt levels are still relatively low. And therefore, you want to just look at valuations from a perspective of how much debt is in the economy or has been taken off by companies. And therefore, even though optically ASEAN valuations may look a little bit more expensive compared to the rest of the region, I'd say that they are justified because of the balance sheet structure that they have. In a way, the second part of your question as to what will it take, I guess the economic slowdown that we are witnessing at the moment, particularly driven by China, is starting to have impacts. We just were in Thailand recently and met with several companies. And what we now start to see is that the consumer is slowing down, and we're starting to see earnings downgrades and people derating companies. Same thing in the Philippines. In fact, this week we are going to spend 3 days meeting companies. But as we see the results for the third quarter, we're starting to see significant cuts in earnings estimates coming in the Philippines as well. So my estimate is that even in ASEAN, we are going through an economic slowdown, which is forcing companies to think about cutting costs or cutting down capex, which will in time lead to lower valuations. I'd say we've always thought about risks from our perspective as being not getting our company investments right. We are, as I mentioned to you, at a point in time when the economies are slowing. There is this headwind of the strong dollar, which has always been a very, very big force to reckon with. Whenever the strong dollar is prevalent, what you find is that Asian assets tend to struggle. But to me, it's always about finding the companies and making sure that they are able to deliver. We look for long-term sustainable growth businesses. Having said all of that, to go to your question, the biggest risks that I would think about, I refer to the strong dollar and then China. I think China's economy and the way they handle the currency, a lot of people have views saying that it might depreciate, some people think it might be stable. We are not macroeconomists, but I'd say that's a very, very big risk we keep in mind. And then beyond that, it does come down to execution on company levels. We are more focused on individual companies. Some of these macro risks, we have to take it as they come. We try and make sure that we invest in companies that are able to survive economic downturns. But if they do not execute when times are tough, that will be a risk I have to carry on my portfolio.